Good afternoon. Here is the one thing worth understanding today. Two pieces of news landed on the same Wednesday, and read together, they say something the headlines mostly missed. The minutes of the last Federal Reserve meeting showed that the live debate inside the committee was not about cutting interest rates. Three officials wanted to raise them. And on the very same morning, the Treasury announced it would double the size of its buyback operations in long-dated bonds, after the 30-year yield hit its highest level since 2007. So one arm of the government is worried enough about inflation to discuss tightening, while another is stepping into the bond market to keep the cost of long-term borrowing under control. That is the story today. The board, the S&P 500, rose about 0.33% to 7,715, and the relief came from bonds rather than from earnings. At the long end, the 30-year Treasury settled at 5.196%, down 9 basis points, but the number that tells the story is Tuesday's, when it touched 5.337%. That is the highest yield on the 30-year since 2007. The 10-year settled at 4.647%, down 6. Gold closed at $4,562 an ounce, up 3.2%, firmer as the dollar eased on the drop in yields. Bitcoin traded near 68,400, up roughly 6%, its biggest move since March, and volatility went the other way entirely. The VIX fell more than 5% to 15. A calm equity market, sitting next to a 19-year high in long bond yields, is itself the divergence worth noticing. Now the segment this publication is built on, three places where the consensus and the evidence have come apart. The first, everyone believes the Federal Reserve's next move is a cut, and the argument is only about timing. The tell says the committee was arguing about the opposite. At the July meeting, the Federal Reserve held rates in a range of 3.5% to 3.75%, but the vote was 9-3, the most divided in years. And all three dissenters wanted a quarter-point increase. Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Logan of Dallas. The minutes go further than those three, recording that policy tightening would likely be necessary if inflation did not decline, and that some participants thought financial conditions might not be tight enough to get inflation back to 2%. High conviction, because this is the official record rather than commentary. The second, everyone read the Securities and Exchange Commission's crypto announcement as a rule change that has already happened, and a lot of the coverage called it the start of a new issuance boom. The tell is in the calendar. What was published is a proposal, and it carries a 60-day public comment period that runs from the date it appears in the Federal Register. After that, there has to be a vote, and after that, realistically, litigation. What is genuinely new is worth stating precisely, because it is the tradable part. There is a startup exemption of $5 million over 4 years, a fundraising exemption of $75 million a year, and a path for a token to stop being treated as a security if the network behind it becomes sufficiently decentralized. That last piece is the novel one, because it speaks to terminal legal risk on assets that already exist, not just to new issuance. Medium conviction on how it lands, high conviction that the timeline is being badly compressed in the retelling. The third, everyone still scores the artificial intelligence build-out by watching how much the largest technology companies spend on it. The tell is that the interesting question moved to who is lending them the money. Since September, the largest cloud and chip companies have more than doubled their combined United States dollar debt to over $360 billion. In 2025, those firms issued a record $121 billion of debt, more than 4 times their average annual borrowing in the preceding 5 years. And the demand side is where it gets uncomfortable. Coverage ratios on hyperscaler bond deals, which is simply how many times oversubscribed each sale is, fell from roughly 5 times in February to under 2 times by July. The marginal dollar is moving toward private credit and off-balance sheet vehicles, where it is considerably harder to see high conviction on the figures, which come from bond market data rather than from company guidance. Follow the money, starting with rates, because everything today runs through them. The mechanism is worth spelling out. The Treasury raised the maximum size of its liquidity support buybacks in longer-dated bonds from $2 billion per operation to at least $4 billion. It covers the 10 to 20-year and 20 to 30-year parts of the curve. It begins on September 9th, and it is scheduled to run through November 4th. A buyback means the Treasury purchases its own older bonds back from the market. It does not retire the debt, and it is not the Federal Reserve creating money. What it does is put a dependable buyer into a corner of the market that had become thin and disorderly. Yields fell immediately, the dollar softened as those yields dropped, and gold rose 3.2% on that softer dollar. That is the chain, and it ran in a single session. Now the crypto side, where price and positioning told two different stories. Bitcoin traded near 68,400, up roughly 6%, its biggest single move since March. But the move was not primarily buyers arriving, it was sellers being forced out. Roughly $1.23 billion of bets against Bitcoin were closed at a loss inside a single hour. That is a positioning event, not an adoption event. And the distinction matters, because forced covering produces a sharp move that has no natural follow-through once the shorts are gone. Three things arrived at once to trigger it: the Securities and Exchange Commission proposal, a White House meeting with senior crypto executives, and the drop in borrowing costs that came out of the bond market. Note that two of those three are really the rate story again. A word on sentiment, drawn from market and social sentiment monitoring rather than from prices. The commentary today clustered around three things, and the clustering itself is informative. Fiscal anxiety was the loudest theme by a wide margin, driven by the debt milestone. Crypto commentary was near euphoric and almost entirely about the regulatory headline, with very little attention paid to the 60-day comment period underneath it. And the artificial intelligence conversation stayed almost entirely on product capability rather than on financing. What is striking is what barely registered: the move to a 19-year high in the 30-year yield, which is arguably the most consequential price in the world right now, generated a fraction of the discussion that the round number on the debt clock did. When attention concentrates on the symbol and ignores the mechanism, that gap is usually where the mispricing lies. So here is the tell, the single most revealing pair of numbers today. On Tuesday, the 30-year Treasury yield touched 5.337%, the highest since 2007. On Wednesday, after the Treasury said it would double the size of its long-dated buybacks, it settled back at 5.196. Those two numbers, one day apart, are the whole story. The first is the market telling you what it thinks long-term United States debt is worth. The second is what happened when the issuer of that debt announced it would show up as a buyer. Today's Focus episode takes that apart properly, including the honest counter-argument that this is ordinary liquidity management and nothing more. Watch that one next. Sectors in play, and today there are three worth your time. Rate sensitives were the obvious winners. Anything valued off long-term discount rates, which means housing, utilities, and the longer duration end of technology, got direct relief from a 9 basis point drop in the 30-year. Crypto-linked equities moved hard alongside the token, and the caution is the same one as in the underlying, that a short squeeze flatters everything it touches for a day or two. And the third is banks, where the read is genuinely two-sided. A calmer long end is good for the value of what they hold, but a Federal Reserve that is debating hikes rather than cuts changes the funding cost outlook in the other direction. On the fiscal news itself, the debt crossing $40 trillion is a slow variable, not a trading catalyst. It does not move a sector today. It moves the discount rate on everything slowly for years. On the radar, September 9th is the date to write down, because that is when the enlarged buyback operations actually begin, and it runs through November 4th. Jackson Hole is days away, and after minutes, this hawkish the tone that matters more than it did a week ago. The 60-day comment window on the crypto proposal starts from Federal Register publication, and Congress returns to a debt limit of $41.1 trillion that budget analysts think borrowing could reach by early next year. Then the scorecard, because this publication writes its calls down and grades them. Today adds one. The enlarged buybacks begin September 9th. If the long end is fundamentally healthy, and this was routine maintenance, the 30-year should hold below 5.3% through the end of the year, if it breaks back above that level anyway. The demand problem was real, and the buyback bought time rather than a solution. That is dated, falsifiable, and checkable against us. Close. If you take one idea from today, take this one. We have organized our entire attention around one committee and 8 meetings a year. And this week, the thing that actually changed the price of long-term money was not a Federal Reserve decision at all. It was a debt management announcement that most people scrolled past. When a government's debt stock gets large enough, the mechanics of managing that debt start doing the work that monetary policy used to do on its own. Which leaves one question worth sitting with. Was Wednesday routine plumbing, or was it a blink? That is the brief. This is the asymmetric signal. One contrarian read a day. Subscribe, research and education only, and nothing here is financial advice.